Hi, today we will be discussing the WorldCom Scandal of 2002. Let's begin. WorldCom was an American telecom company that at some point was one of the largest long-distance providers in the United States. It came to be around the time that the Enron and Tyco scandals surfaced as well. It was established in 1983 by Murray Waldron, William Richter, and Bernard Ebbers under the name of Long Distance Discount Service, or LGDS, before it was changed to WorldCom. With a $650,000 loan, they purchased the necessary technology to route long-distance calls. The CEO offered low rates, which resulted in a mass success and a capitalization as high as $186 billion, with up to 30 competitors. However, when the tech boom had a decline and companies strayed from spending on tech services and equipment, they resorted to fraudulent accounting techniques to continue to portray high financial profitability. In doing so, investors became curious of their growing profits, especially after the Enron scandal broke in 2001. The SEC began their investigation in 2002, and it came to light that their chief executive officer, Bernard Ebbers, borrowed $408 million from the WorldCom's board of directors to cover margin calls on loans secured by company stock. He quickly resigned his position on April 30th of 2002 and was later convicted 3 years later in 2005 of securities fraud, conspiracy, and making false filings. He was sentenced to 25 years in prison and at the time of his sentencing was 63 years old. After serving 13 years, he was granted a compassionate release due to a health decline that caused him to have legal blindness, dementia, anemia, and significant weight loss. He sadly passed in 2020 at the age of 78. Some of the tricks and techniques WorldCom used were definitely questionable. They aggressively bought rival companies to attempt to gain market share. Combined with a major drop in revenue and rates, they were really suffering a great decline. To prove they were financially viable to its board and shareholders, they inflated their profit numbers. They inflated their net income and cash flow by recording their expenses as investments. This helped report a profit of $1.38 billion instead of a net loss and an over-exaggerated income of $3.8 billion. Some of the people involved in the discovery of this scandal are Cynthia Cooper and Gene Morse. Cynthia served as vice president of the WorldCom Audit Department, and Gene Morse was an auditor. Their concerns included the use of reserves to boost company income, their capital expenditures, which concerned another employee and was fired for this reason, complicated accounting terms like prepaid capacity that were used to hide the movement of capital, and the lack of evidence to substantiate different financial transactions, including a $500 capital expenditure. Both employees performed their own investigations and an audit to get to the bottom of this. They were questioned by Scott Sullivan, the CFO at the time, to delay the process. Because of this, they contacted KPMG, the external auditor, and the WorldCom Audit Committee. Once things started to reveal themselves, WorldCom could no longer hide their fraudulent acts as well as they could before. They had to adjust their earnings from 1999 to 2002 by $11 billion, while the fraud was estimated to be $79.5 billion. The only option was to file for bankruptcy, which they did so on July 21, 2002. This happened a month after their former auditor, Arthur Andersen, had been found guilty in court. In filing, WorldCom noted $107 billion in assets and $41 billion worth of debt. Bankruptcy also meant that they could continue their operations and be able to service customers, pay its employees, and keep their assets, as well as have time to restructure it within the corporate marketplace. As previously discussed, CEO Bernard Ebbers served time for his crimes, and so did CFO Scott Sullivan, who received a sentence of 5 years in prison after pleading guilty and testifying against Ebbers. After debtor in possession financing, WorldCom emerged from bankruptcy in 2004 and was rebranded as MCI, which was a telecom company that they acquired in 1997. Verizon purchased MCI in 2006 along with its assets. After a settlement with the SEC, MCI agreed to pay shareholders and bondholders $500 million in cash and 10 million shares. This all led to the formation of the Sarbanes-Oxley Act in July 2002, which was made to strengthen disclosure requirements and penalties for fraudulent accounting. In the end, I guess you can say it's better to stick to ethical procedures and accounting principles. Thanks for watching!